It would have been nice if you told me to buy the Dow October 1st, Gabriela. I don't think you ever really got very positive, did you?
So it's been interesting. I mean, certainly a very strong month for risk assets in October. We really think it was based on a little bit more optimism about a shift in central bank policy, actually a bit more optimism about the odds of a soft landing, and more optimism about lower tail risk in Europe around the energy crisis as well as market instability. In terms of the central bank piece, we do think there's room to continue being a bit more constructive here. And that's because this shift in central bank policy is one that's much more tempered than the hopes from the summer when investors were going from rate hikes to rate cuts. Now it's more of just a hope that we're going to a slower pace of rate hikes and eventually a pause early next year. So we'll have to see, especially the tone of the press conference next week. We don't think the Fed will already commit to reducing the pace of hikes to 50 basis points in December, but we can look for clues that they're leaving that door open and validating this market optimism, especially if they mention the risks being a bit more balanced between doing too much and too little, and also if they start stressing more forward-looking indicators of inflation, which have started to come down more meaningfully.
What would you think would have to happen for this to be more than a, I don't know, what would you call it, a bear market rally, a snapback, a sort of a reversion to the mean, whatever? What would set us up for another, what do we need, 20? What do we need for a bull? 20%? If we got 14, we're getting close already.
I think we would need two major things. The first is to validate this idea of a shift in central bank policy. And for that, what we actually need to see, and what we're going to be watching after the meeting tomorrow, is inflation break-evens. If you get a situation where central banks are able to actually shift their stance by reducing the pace of hikes and eventually pausing, while inflation break-evens are contained, that's a sustainable shift in policy. And that can ultimately only happen if we continue moving along the disinflationary process. So we're going to be watching for slower month-over-month pace of increases in core inflation, in wage growth, as well as in monthly job creation. The second thing we need to watch, I think, is a bit more of a capitulation here on this idea of a soft landing. The data so far has decelerated, but has still stayed resilient if you look at consumer spending on services or the jobs market. But actually a more sustainable rebound is one where there's enough pessimism reflected about future economic growth and what that means for future earnings growth. It's been encouraging to start to see earnings get revised down at a quicker pace in October by 4 percentage points, but it still leaves investors expecting 6% earnings growth next year. Be much better if we continue revising expectations down, especially around margins, and we end up in a point where there's already enough pessimism embedded, either flat earnings growth to even negative 10% earnings growth if recession is truly a base case.
Gabriela, what the soft landing, where do you have, is that actually possible now after what we saw last week?
I mean, it's possible. We would still put the odds of a recession happening over the next 12 months as being extremely elevated versus what's normal. We would put it at least at 50%, which is significantly above a normal probability for recession, which is much closer to 15% at any given time. The reason it's not guaranteed is actually because you are still seeing pockets of strength around consumer spending and services, really helped by a still very, very strong labor market. So ultimately, probably what's going to happen is we see a delayed start to a recession, given all of the financial tightening we've already seen and the elevated inflation levels. So we're talking about expecting a recession beginning towards the middle of next year. So a soft landing is still possible, but recession odds do seem elevated. And I think for it to be a sustainable market rebound, we need to embed that recession probability more into earnings expectations and also into credit spreads, right? If you look at high yield spreads, still not embedding this more elevated probability of recession quite yet.
Right.
So for us, a bit too early to be meaningfully dialing up risk here.